Hi, you guys. I'm Phil Town from Rule 1 Investing, and today we're talking stock market bubbles, specifically whether we are currently walking into another big tech bubble like we saw in 1999, driven by AI this time. There's been a lot of commentary over the past few years about AI and the Magnificent Seven, and as we've seen, this speculation has sent the S&P 500 absolutely rocketing into the sky blue yonder. But when you turn off the CNBC reports and instead you kind of look at a rational view, kind of a Buffett-style view of what investors are saying and seeing, the message doesn't look quite so rosy. In fact, I think you're much more likely to hear great investors talk about how the last few years resemble another tech bubble that's about getting ready to pop. Buffett is sitting on $350 billion in cash, and I'm sitting on a measly $100 million. So what's the truth about this? Well, let's talk about it. So the first thing we need to understand is why investors are now comparing the market today to 1999, the moment before the NASDAQ dropped peak to trough almost 80%. And the more you look into it, the more similar the two situations starting to look. In 1999, the internet was undeniably the transformational technology of the future, no question. But the problem was it was early in the process and investors had no idea which long-term winners would emerge from the space. And what this led us to, and what led investors to, is making big bets on companies that you probably never heard of. Or maybe you have. Pets.com, Webvan, eToys, Broadcast.com, and so on. Investors were buying virtually any company that was related to the internet. You stick a .com on the end of it, they'd buy it because they thought anything .com was going to be the next big thing. And the problem with that, of course, is when they made these bets, they completely abandoned fundamental analysis, and instead, they just bought on the hype and the bet into the future. Now, the question is whether we're seeing a similar situation today if we just kind of replace .com with the word AI. And while investors today are convinced that AI is going to be even more transformative than the internet, which it very well could be, I mean, people are talking about it like it's the new electricity, they're not going to be as crazy today as they were in 1999 on valuations. Magnificent Seven, for example, is a pretty good indication that people are kind of keeping the lid on a little bit. These are 7 companies that are at the very top of the S&P 500 index: Apple, Amazon, Microsoft, Meta, Nvidia, Tesla, and Google. But the PE ratios aren't that crazy. They're not 1999 PE ratios for most of them. For example, Meta and Google are both at 27, Amazon's 34, Microsoft 37, Apple 38, Nvidia 52, and well, okay, Tesla is, pretty out there, the staggering 250 PE. They're a little bit the outlier. Now, these valuations mostly are nowhere near as crazy as some of the PEs in 1999 when Yahoo was at 11,000. PEs usually reflect a market consensus about what the long-term future compounded growth rate's going to, or is, frankly. Typically, the PEs are about 2 times the expected future growth rate. Now, can Meta and Google grow for the next decade at 14% a year compounded? Yeah, they totally could. Can Amazon grow at 17%? Probably the high end, maybe. It could do it. Microsoft and Apple, can they grow at 19% per year for the next 10 years? It's getting out there, but it's not insane. Nvidia, could it grow 26% a year? That means it will double 3 times in the next 10 years. Can Nvidia be over 800% larger? Oh, now we're a little bit breathtaking. And let's not even do Tesla. 250 PE implies 125% per year growth rate for the next decade every single year. And I don't know, I can't even do the math on where that's supposed to go. So what's the real problem here? If these companies are the winners of the AI revolution in the long run, and that remains to be seen, today they are all at or above their very optimistic intrinsic value, if they are the AI winners. So the problem isn't that the PEs are crazy. The problem is the PEs are reflecting the fact that the investors are thinking these guys are going to win. Now, before the dot-com bubble burst back in 1999, Warren Buffett wrote a great article for Fortune magazine in which he likened the development of the internet to the development of the automobile back in the early 1900s. And what he said was, despite it being obvious that the development of the automobile was going to be the next big boom for America, it was almost impossible to see who the winners would be back during that time. At the beginning of the automobile revolution, there were hundreds of automobile companies in America. But if you fast forward to the turn of the century, right, 80 years later, 90 years later, only 3 companies remained: GM, Ford, and sort of Chrysler. And in 2008, 2 of those went bust. So his point was, as an investor, you might be able to see who the next big thing is going to be coming a mile away. But to be able to correctly predict the winners in that space is a speculative game. Investors speculated about the dot-com winners in 1999, and when the bubble burst, they lost trillions of dollars. And that same thing could be happening again now. We're at the very early stages of this AI revolution, but the Mag 7 is being priced like they will for sure be the winners. This whole AI revolution that just kicked off with the release of ChatGPT, that was just like 3 years ago. And now if the Mag 7 were making it a sure bet that they would win and they were available to buy at a reasonable price, well, shoot, wouldn't Warren Buffett have been spending that $350 billion he's sitting on? The truth is, it's just too early to be making a confident Rule 1 style bet on AI businesses. And those that are doing so, I think they're just gambling their clients' money. Right now, there's really only one company that's reliably making money directly from AI, and that's NVIDIA. And that's because today, OpenAI, Meta, Microsoft, Google, Amazon, they all need NVIDIA GPUs to play the game. It's a bit like back in the California gold rush, when people who made the real fortunes turned out not to be the miners. They were the people who were providing the miners the picks and the shovels and the clothing and so on. NVIDIA is like today's version of Levi Strauss. And that's just the case today. It may not be the case tomorrow. And that's the point. Nobody knows with any degree of certainty. Now, beyond NVIDIA, the Mag 7 is burning cash on AI development like you can't believe. They're like basically supporting the economy right now. Microsoft is pouring billions into OpenAI and no end in sight. Google's trying to walk a tightrope as they integrate AI into search because AI could destroy their existing ad cash cow. Tesla is busy promising AI-driven full self-driving, and it's priced as if it's a sure thing. But it's not there yet, and Waymo ahead of them still. Amazon and Meta, they're throwing billions into data centers, and Apple just seems confused and directionless. And while we love using these large language models like Gemini, ChatGPT, and Grok, these LLMs may become an interchangeable commodity with no winner at all. It's simply too early to tell. And if history teaches us anything, it's that even if AI can make the leap from LLMs, probably commodities, to artificial general intelligence, where it's smarter than humans, and completely transform the world, who knows if the current players will be the long-term winners? The truth is, nobody knows where this will all be in 10 years. So what do we do about all this as Rule 1 investors? Well, this is where we fall back on the discipline that Warren and Charlie have been drilling into us for decades. Despite what the news is reporting, despite the endless AI hype pieces in the media, we don't go chasing hot new things when we don't have a high degree of certainty where they're going to be in 10 years. We want to buy businesses that we don't have to worry about. I want to sleep at night. And we don't buy companies at nosebleed valuations just because everybody else is. We stick to what we know, our wheelhouse, companies we truly understand, where we see the moat that will protect our profits from competition for years to come. And just as importantly, we are patient. We wait for the market to serve those companies up to us at a price that gives us that all-important margin of safety. Now that's the discipline. And here's the thing. While Mag 7 prices are on fire, they're also about 60% of the S&P 500 price rise. The rest of the market, all the other 493 businesses, are being priced not so high. And some of them are companies we want to own. Now, if history repeats, and it usually does, we might not have to wait much longer for that buying opportunity. The dot-com bubble collapsed the entire market back in 1999-2000, and in the wreckage were incredible opportunities to buy some of the greatest businesses of our time, all at dirt cheap prices. Get this, you guys. Apple, which was already a fabulous product company, went from $1.12 down to 26 cents. Now those are split adjusted prices. It is now at $257. That's a return of 32% compounded annually for 25 years straight. $10,000 in Apple at 26 cents is now $9.8 million. Now that's worth waiting for, particularly because we could be very close to the time in this market when that happens again. Now, the lesson is simple, you guys. Stay rational, stay patient, get into cash, and when the market finally serves up these opportunities, be ready to pounce. And if that sounds like something you'd really be interested in learning more about, I would love to invite you to our next 3-day Rule 1 investing workshop. We teach entirely online. We go through the full 4-pillared investing approach that we've taught to over 25,000 people all around the world that we got straight from Warren Buffett. It's not a workshop where we try to upsell you all day long. We don't sell anything here. We just teach. The stats don't lie. Our participants love this workshop. We've got net promoter scores that beat even the likes of Harvard and Yale. So if you'd like to get serious and really take charge of your financial future, please come and join us at the next event. The details for that can be found in the description, in the pinned comment, and also by scanning the QR code on the screen. Now, with that said, thanks for watching. Now go play.